welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
If you spend all your time arguing with people who are nuts, you'll be exhausted and the nuts will still be nuts. Nothing defines humans better than their willingness to do irrational things in the pursuit of phenomenally unlikely payoffs. This is the principle behind lotteries, dating, and religion. Tell me what you need, and I'll tell you how to get along without it. There's nothing more dangerous than a resourceful idiot. If it weren't for the last minute, nothing would get done.
The last 3 years have served up one of the market's favorite plot twists. The Fed's balance sheet shrank nearly 24%, yet the S&P 500 soared nearly 82%. So much for the idea that stocks cannot rise without a QE drip. Turns out Wall Street can sprint even when the Fed is on a diet. So what drove the rally? Earnings resilience, tech dominance, and perhaps the timeless market rule, don't bet against human optimism or stubbornness. It's a reminder that liquidity may matter, but narrative, confidence, and FOMO often matter more. Like Mark Twain once said, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. India's Capex story has a clear theme. The government is sprinting, the private sector is crawling. Over the last decade, central government Capex has grown at a powerful 16% CAGR, while most private sector indicators, industrial credit, capital goods production, cement volumes, engineering imports, etc., have been stuck in low gear. New investments have improved only slightly, and project completions, once booming, have cooled sharply from earlier decades. In short, public Capex is carrying the entire scoreboard, while private Capex waits for better visibility, also known as confidence. If India wants a true investment cycle, both engines need to fire, and not just the governments. Large caps in India have quietly slipped to near their lowest ever share of total market cap, which is unusual in a market loved for its domestic liquidity and retail enthusiasm. When the giants shrink in weight, not in value, it usually signals one thing: the market has been busy chasing everything except the obvious. For contrarians, this is the kind of setup that makes them smile politely while everyone else argues about small caps. Historically, periods of extreme underweighting in large caps haven't stayed that way for long. Sometimes the safest place during volatility is not hiding, it's simply sticking with companies big enough to survive the storm. If there's one thing the last 5 years have taught us, it's this: no asset class stays on top for long. Small caps ruled 2021, mid caps in 2024, and 2025, silver suddenly decided to behave like a tech stock. Meanwhile, equities, gold, REITs, and fixed deposits keep rotating like they're taking turns hosting a family dinner. This constant reshuffling is exactly why chasing last year's winner is the reliable strategy for disappointment. The leaderboard keeps flipping because markets love humility drills. The takeaway: diversification isn't just wisdom, it's also self-defense. Silver is not just a precious metal anymore, it's becoming the solar industry's favorite snack. Demand for silver in solar panels has surged from under 100 million ounces a decade ago to nearly 250 million ounces today, and forecasts suggest that it could hit 400 million ounces by 2030. That means solar alone could consume half of the world's annual silver supply, a dramatic shift in resource dynamics. When a single industry starts hogging half the buffet, prices, miners, and investors all start paying attention. Clean energy may save the planet, but is definitely putting silver on overtime. Indians have become ChatGPT's second largest users, contributing over 9% of global traffic, right behind the US at 15%. That means 1 in every 10 questions asked worldwide now comes with a high chance of starting with "brother, explain like I'm 5" or "make it witty." Brazil, the UK, and Indonesia follow, but India's digital curiosity clearly stands out. With a young population, cheap data, and an unmatched love for asking one more question, India is fast becoming the world's AI engagement capital. ICICI Prudential's Equity Valuation Index sits firmly in the neutral zone as of November 2025. Not expensive enough to panic, and not cheap enough to celebrate. The market equivalent of standing in the doorway deciding whether to enter or to leave. Historically, this middle band means simple things: don't chase rallies, don't fear dips, and don't expect bargains to fall from the sky. Volatility is creeping around, but nothing hints at extreme overvaluation or deep value. In short, it's a good time to stay balanced. Maybe act selectively, hedge sensibly, and avoid heroic bets.